Have you ever heard financial terms or concepts and thought, this doesn't make sense? Well, you're in luck. Welcome to Make It Make Sense, the podcast powered by Acclaim Federal Credit Union, where we break down the world of financial literacy. At Acclaim, our goal is to connect you to financial wellness, and this podcast is here to lead the way. Whether you're just starting out or looking to sharpen your financial skills, we've got you covered. Let's make it make sense together. Here's your host, Christy Smith.
Welcome to Make It Make Sense, where we attempt to make sense of financial concepts. Today, we have Valerie Lentz. Valerie is the Senior Vice President of Performance Pro Consulting. Valerie has over 20 plus years experience in reading credit reports. To me, she can read a credit report better than anyone I've ever seen, and I'm very excited to share her with you in episode 5. I can't believe that this is our 5th episode, and I'm excited that we have Valerie to share that with us. Today, we're going to be talking about cracking the credit code and how credit scores work and why they matter. I've been in this business for over 20 years, and I know that this is something that, we're passionate about. I know it's something that you're definitely passionate about. You have trained a lot of our employees how to read credit reports. And I said in my intro that you might be the best I've ever seen. So I'm giving you tons of kudos that you could read a credit report better than anybody I've ever seen. So it's fantastic. But I'm excited to share your knowledge with our listeners. So let's just jump right in. What exactly is a credit score and why is it so important?
Well, thank you, Christy, for letting me join in on all this, because I do love credit and I'm very passionate about credit and educating our members and your members as well. But a credit score is a number ranging from 850 to 300, 850 being the best score out there. But the number, it actually predicts the probability of delinquency in the next 2 years. And that's what it's actually predicting. And why is it important is a couple different reasons. One is it may determine the rate that you're going to be paying on your next car loan, your mortgage, your credit cards. But it also can determine if you get a job. Some employers actually pull a copy of your credit report and look at it and determines, yes, we want to take the risk of this to employ you or not. Another one would be for younger borrowers, if they're planning on renting an apartment in the near future, is landlords will pull it. Determine if you qualify for that apartment. 2, they'll determine what security deposit you may have to pay. So someone with a good credit score can pay $250, or they may have to pay up to $1,500 for their security deposit. So that is a lot of a big range if your score is a little on the lower side. The last one is auto insurance. Auto insurance companies in many, many states actually pull a copy of your credit report and determine your premium based off of that and your driving record. If you have a good score, you may pay less. But if you have a weaker score or lower score, you may pay 97% higher than someone with a higher credit score. So that is a big difference. So if it's $100 and a higher credit score, you pay $197 if you have a lower credit score. So at the end of the day, it's not just for the car loan, it's everything else that can go into your daily things. But those are the main ones that I've seen, and why it's important to look at is so you can pay lower interest rates, which does cost you a lot of money at the end of the day.
No, and you're exactly right. One of the things that I know, I didn't grow up and we didn't really talk about it in school, is, credit and, how to get a good credit score, or, just the mix of credit and things like that. And I think that it took me to get a job at a credit union before I, really started to understand the value of credit and why it was important for me to have a good credit score. And then, the other caveat is understanding it. And that's a whole nother issue. So thank you for that. It is extremely important for us to have good credit, but I don't want to discourage people that don't have good credit either. There is a pathway to get that credit back up. And so I don't ever want to discourage anyone, but for anyone just starting out, it is extremely important to to not do what I did and wait too late and try to figure out, what is this credit score thing about? So, very good tips and tricks and good information. What are some common misconceptions about credit scores?
Thinking about that, there's a few things depending, and I'm working with the younger borrowers. Their misconception is if I get my first credit card, I'm going to go and open a new credit card all over the place that I qualify for. And it's not just open the new credit card, it's actually using them and not paying them down. So it looks like you're out there shopping for credit and it actually can hurt you. Everyone thinks it may help you because you're getting more credit and even if you make your payments on time, that can actually hurt you in the end. So good rule of thumb is an average of two to three new accounts a year versus opening them up, multiple ones during the same cycle. But one year you may have 0 new accounts. The next year you may have 3. That's okay. But good rule of thumb is 2 to 3. So if you're coaching your young borrower in your house, it's definitely 2 to 3 a year. The other one that I've noticed a lot of misconception is that they think income is based, your credit score is based off your income. It's not. They don't not know what your income is. It looks at the other things, payments, how you handle your credit, how you handle your credit card limits. So those are the big ones that you have to look at. It's nothing to do with your credit. And then the other one may pop up a little bit more is authorized users. Everyone thinks they want to piggyback off their parents' credit and use their credit card as an authorized user account, but that actually can help you or hurt you depending on how your parents handle that account. And that's if some of the financial institutions, a lot of them are not reporting authorized users to credit reports anymore. So you won't benefit from it. So that's where they have to develop their own credit history, not piggyback off their parents.
Yeah, and that's true. I know that we look at authorized users here, and sometimes people forget that they're an authorized user on someone else's account. And so when we bring it to their attention, they're like, oh, no, that was back when I was younger. And I'm like,
yes,
well, no, it's still there. And so it's really important to understand if you're an authorized user and making sure that you pull your credit at least, what would you say, every once a year? Or how do you feel about Credit Karma or something like that to monitor your credit?
Actually, use Credit Karma myself just to keep my credit score monitored. It is nice because you do get notifications saying, hey, someone pulled your credit report. So then I'm like, oh, okay. So it kind of helps with identity of the fraud side or anything that might be out there. What I would also like to, I'll say air quote, is that the education side is probably not as strong, but it is good to use for the awareness side of Credit Karma. And I think there's a couple other ones that are out there that are free to everyone. And like you said, how often to pull it? I would say be aware of it for at least aware of it on it or for 1 year, every year to definitely look at it. Or before a major purchase. So if you're planning on making a car, getting a car soon, getting a mortgage soon, a couple months ahead of time, pull a copy of your credit report or go on to Credit Karma or even your financial institution may have it on their, part of your mobile app and look at your credit score and determine if something's might have happened to it. Because if you can get it fixed before the major purchase, you can save a lot of money on interest because you'll get a higher interest rate. Lower interest rate, excuse me.
Yeah, know that I use Credit Karma as well, and I use it for the same thing. I want to know because it alerts me every time my credit's pulled, and I want to make sure for the fraud piece that no one's doing anything and I'm not aware of. So, yeah, I think that's really important. How can young people build a good credit history from scratch? I know that this is a question we get a lot.
So I have 2 teenagers, and they both have actually gone through my training on credit reports. So they are very because like you said in the beginning, schools, they just don't spend a lot of time on this part of it. And it's very important once you turn 18, you can qualify for certain types of loans and credit cards. So get the education out there early. So the best practice for younger borrowers, and I even coached my own daughters on this, is a credit card. And a credit card for a couple different reasons is one, because that can be your oldest trade line on your credit report. And that can help you for many, many, many years to come. So definitely look at that. But there's one part that they kind of miss on this is that when you get the first credit card, don't start spending on it and start not paying it down or paying it off every month. Use it appropriately and keep the balance lower, because that's what hurts you on your credit score itself, is if you start using that whole limit and not paying it down. And then two, it helps you build on-time payments, because when you have a credit card, it can keep on going. And when you're making the payments, it's going to say, oh, you made another payment on time. It's going to help you build up that score as well. So that's the one area that I do like. Another option is if you actually want to do a shared secured type of loan where you're securing your own money and borrowing against it. And then it shows some on-time payments as well. The one thing I do like to stress when you do a shared secured loan is do it for at least 6 months, because that shows 6 months and 6 on-time payments. If you do it for 1 or 2 months, it's really not going to show much on your credit report. So having it out a little bit longer would be great. And the one misconception and the common mistake, and you said it before, is that a lot of people, younger borrowers, wait until they need credit versus building it as they go and as they get older. So it is important to start out between 18 and 20, start looking at the different options for you. So when you want your first car loan or you need to get a personal loan, that's going to help you as well. And a lot of younger borrowers do have student loans on their credit report, and that does impact your credit score. So they start early, but you really want a type of credit card, not just student loans on your credit report.
Yeah, I think that that's really important. And I know that I had that same type of training with my kids. And I told both of them, I said, I have set your credit score up really good. What you do with it from now is on you. But I set you up nice because they got to learn the things that I did not know when I was their age. And again, I'm not bragging because I had to go through that training. But if I didn't work here, I don't know that I would have known what to do, helping or guide my kids, if I hadn't have done some work, if I hadn't already worked for a credit union. So people can listen to that and go, oh, well, I've never even heard of that before. And so, I do like to offer grace for people that they're like, I don't know how to do that. Because I don't think I would have automatically known how to do that if I didn't work for a financial institution. So I do want to offer that type of grace too, because, it's hard enough being a parent and you're like, now you're telling me I've got to work on the credit score too. And so, but it is good to be proactive. What's the best way to recover from a credit mistake, like a mispayment or something like that? We get that a lot too. And sometimes it's just a mistake. I mean, it really is a mistake. Maybe that you have it set up on ACH and something happened and it didn't pay or, or something like that. Or maybe it is a hardship and you just couldn't make that payment. So,
I have seen that. And a lot of the one, and I call them hiccups, little late payments, just a hiccup on your credit. And it is when everyone switches to e-statement. So they totally forget about that credit card payment. And then they realize, oh my gosh, I'm a few days late or late. It doesn't go late and hits your credit report until after 30 days. So that's a nice thing. So you do have a little bit of grace. So if you do miss it or something happened with a hiccup with ACH, you do have a little bit of time. But after the 30 days, the institution can report to the bureau on that, which then reflects into your credit score. So one is, once you get back on time on that car pay or the car payment, start making your payments on time again and continue to make them. And as over time, that credit score will recover from that one hiccup. Now, if you have a couple different hiccups or late payments on your credit report, it may take a little longer because it looks like you're late on a couple different ones versus just one. So I have seen people with one late payment on a credit card from 2 years ago and still have a 700 plus credit score. So it has an impact, but it's kind of lightened impact because they have maybe longer credit lines. The younger borrowers, it may hurt them a little bit longer because of the fact they don't have a lot of history on their credit report. So history and length of credit is going to be important to rebuild. And to help recover, if you do have hiccups or things on your credit report, a shared secured loan would be a great thing, which is, again, securing your own money against that loan and making payments to get on-time payments again, because on-time payments will be the key to that. And also secured credit card is another option that we offer as well. So that would be a big thing to look at. But 6 months is a key to kind of rebuild your score and to rebuild getting those points back.
Yeah. That's really important. And I would also like to offer and get your advice on if you know that you've made that payment. So just, for our listeners to understand that if you know you made that payment, you can dispute that. And, there is a way for that your creditor to have to validate that payment. So I think that goes back to monitoring your report and making sure you know what's on your report.
Yeah, so if you see something that it's reporting incorrectly on your credit report, you can actually go to any of the credit bureaus. There's three: TransUnion, Experian, and Equifax, and dispute it with them directly. And they have to go out to your creditor, whoever you were late with or disputing, and they actually have to get back within the 30 days to see, yes, they were late, or no, they weren't. It's our mistake. We'll take it off. So, but my key best practice is to always go to all three bureaus. Don't just do one, TransUnion or Equifax or Experian. Do all three of them, because you never know who's pulling your credit report. So you don't know if a claim is pulling one report and another credit union or bank is pulling another. And when you get a mortgage, they look at all three bureaus. So you want to make sure all three bureaus are all good, not just one or the other.
Yeah, that's really good, because that also can be confusing for consumers. Is there are three different bureaus that you now have to keep up with, and then what we get sometimes is when we pull a credit score is it's different than what it says on my Credit Karma or whatever app that they're using to monitor their credit, and it's because there are different types of credit pulling software. And so, some people use a FICO score, but then there's Vantage scores, and there's, different types of scores that may weight things a little bit different. So I always tell people, try not to panic too much, but we may not be pulling the same. It may not be an apples to apples score.
No, I agree. And the FICO and the Vantage score, even the Credit Karma pulls the Vantage score, it may be slightly different than someone that pulls the FICO score, which is 90% of lenders do use the FICO score model. So that one would be the one that you want to make sure that you're getting corrected is the FICO, and still be aware of the Vantage score, because that a lot of institutions are coming up and using that now.
Yeah. That is really important. How often we've kind of talked about this, how often someone should pull their credit report, but what I'd like for you to kind of hone in on is what should they really be looking at when they're pulling that credit or reviewing their credit?
So there's two main factors that affect the credit score the most. One is payment history, which we touched on already. That is 35% of your credit score is going to be based off of how you pay your bills. And the next portion is 30% is going to be how they handle their credit card limits. So if you have your balances versus your credit card limits, that comes up as a utilization percentage. And that if the lower balances versus your limits, the better. You want to keep it about 30%. So I'll just use really easy numbers. For a $1,000 credit card, you should have a balance, if you're going to carry a balance, no higher than $300, because then you're maximizing your your points on your credit score. If it starts inching up higher, that's where it's going to actually have an impact on your credit score. So this is where those young borrowers with smaller limits, you want to make sure you're keeping it about 30% of the limit. So add up all your limits on your credit cards and then multiply it by 30%. And that's where if you are carrying a balance, you do not have to, but if you are going to carry a balance, try to keep it under that percentage.
That's really good advice. And I think that was probably the biggest misconception I had, when I was younger is, I've got this credit line. I'll never forget my first credit card was a Belks card because I wanted to buy clothes. And so I still want to buy clothes. But I thought, oh my goodness, I have this credit line and I can go and buy out, these outfits in this. But then it comes time to paying that back. And then the interest rate was really high. And, I thought, oh my goodness, I didn't realize I was going to have to pay this much more for my purchases. And so it is really important to understand that. But I think that was a misconception for me because I probably overextended that card. And then all of a sudden my credit started to take a dive, and I had to understand pretty quickly that, oh, I'm using too much of this card. So the other thing that I touched on a little bit is the interest rate I was paying on that card. And I think that's really important, even for people that are seasoned. Do you know if you have a fixed rate or a variable rate card? And what are you paying? I think when interest rates were low for so long, that people were just used to paying, but when interest rates started to rise, those payments started to rise. And then, we had some of our members that were like, oh, wait, you offer a fixed rate card? Let me just go ahead and do a balance transfer because I'm paying a whole lot more than what I did when interest rates were low. But they just didn't know to look at, if they were paying a fixed or a variable rate card. So I think that's important too. Do you see that happen for you?
Yes. The credit cards, especially some major credit card companies, the average interest rate on credit cards right now is 24%. So that's all the credit cards from credit unions all the way to the major credit card holders is 24%. So when you're looking at your credit card statements, just kind of keep an eye on what they're paying. I am a self-proclaimed credit nerd, so I look at all the disclaimers that they send with those credit cards. They can float up to 32 to 34% very easily. And it doesn't matter what your credit score is. It's usually one rate for everyone for certain, especially those store cards, like you were saying with the Belks, even like the Home Depot and Lowe's, other ones that are out there, that it goes up to 32%. It doesn't matter if you have 850 credit score or 550 credit score. So I think it's really important to read those disclaimers.
The thing is, especially about credit, and we're talking about credit cards and things like that, like you said, the disclosures. And sometimes when you don't read those disclosures, you don't know that if you're late, that there's a default rate. And then all of a sudden your interest rate is something different than what you thought you were paying. Or, there's several of these, I always call it the small writing. You have to read the small writing because that's where you kind of get in trouble if you don't read those disclaimers and disclosures, and to make sure you understand what you're actually getting yourself into, because those things can increase your payment. And then if you don't make the payment, then all of a sudden your credit score starts to take a dip. So it's kind of a snowball effect, I would say. Valerie, you have offered lots of tips and tricks for our members and our listeners, so we appreciate you. But I always ask a question at the end of the podcast, and we've kind of we were on a trend, and then we kind of broke the trend, but that's okay. Who inspired you the most, taught you the most about financial literacy? And maybe not even financial literacy. It could be credit reporting, since that's what we're talking about today. But who has inspired you the most and given you the most knowledge in this area?
So there's two people, and one was my first credit card. My mom brought me down to the local community bank because I lived in small town Illinois, and I had all my accounts there, and that was when I got my first credit card, and I still have it to this day, and it's still in my wallet because they gave me a chance when I was 18 years old, but I needed it for school. So that's my first trade line, so I will never close it. And two is when I got my first job out of college, I went right into the finance world, working with credit unions. So my former boss, who's passed away, Rex Johnson, taught me everything, which was one of the greatest things because he taught me the passion of credit and how to keep on educating people. And he really taught me a lot about credit. And then now just being in credit unions every day and working with loans every day and working with members every day, I really, the passion keeps on coming out. So I'm hoping I'm inspiring some other people to keep their credit scores up and their credit really well. But my mom started it off because she told me what to do. But she didn't know all the credit side. She just said, pay your bills on time. And then Rex really kind of filled in that side because he was in the industry for a long time.
Yeah, I think especially people in the industry, they know the name Rex Johnson,
Yeah.
and I know your mom, and she's fantastic. So you had two two great mentors. But, just to let our listeners know, Valerie is very passionate about this subject. She's very passionate about credit unions, about communities, and about, helping people. And that's what we're all about. And that's why we're proud to partner with Valerie and PPC. And we just really appreciate you joining us today. And we hope you have a good day, and we'll probably see you very soon.
Thank you, Christy. We really enjoy working with you and your team, so we really appreciate it. And thank you for inviting me into your podcast.
Yes, thank you.
Thank you.
Thank you for listening. Please visit us at acclaimfcu.org for more valuable resources. Remember to click the follow or subscribe button to make sure you don't miss future episodes.